Hi everyone, welcome to this tutorial. In this tutorial, we are going to solve some problems for chapter 3, chapter for the week 3 for the course Financial Management 2. So, in this chapter, we discussed debt policy and we had four learning objectives, if you remember. And this chapter is from Fundamentals of Corporate Finance 6th edition, written by Briley, Myers, and Marcus. So, in simple, if we summarize learning objective here, we mentioned why capital structure affect or does affect or does not affect the firm value in private capital markets. Remember that we start to discuss these theories from Modigliani and Miller's, and the first one is about Modigliani and Miller proposition under no taxes assumption. So the second one is also Modigliani and Miller assumptions under the taxes. And in that case, we mentioned that tax has a role. What kind of role here? If a company use debt in its capital structure, then they will have tax in benefit. It is because they will show interest and expense and pay lower taxes. It was the logic. So the third third objective was about the trade-off theory. In that theory, we mentioned that there is an optimal capital structure. It is because under a certain point, company will stress by using more and more debt in its capital structure. So at the fourth learning objective was about financial hierarchy theory, or in other words, pecking ordering theory, and we discussed this theory and mentioned that firms has a certain preferences over alternative financing tools. The last objective was about the bankruptcy process. We mentioned a little bit what kind of process we have in case of bankruptcy. So we selected four problem here for this chapter. So let me start with the first one. Here we have a case. In this case, we have a common stock and debt of Norton Sludge company are valued at 70 million and 30 million respectively. Investors currently require a 16% return on common stock and 8% return on debt. If Norton Sludge issues additional 10 million of common stock and uses this money to retire debt, what happens to the expected return on stock? Assume that the change in capital structure does not affect the risk of the debt and there are no taxes. So two things need to be mentioned as a remark. First of all, we need to take a look at the capital structure of this company. Here it says equity is 70 million and debt is 30 million. From this, we know that we have 100 million as a capital in this capital structure. So the first thing we need to remember that weight of debt in this case is 30% and weight of equity is 70%. The second thing need to be mentioned is that what about cost of debt and cost of equity? So cost of equity is, as it is given here, 16% required return, and cost of debt, as is written here, 8%. So from this argument, we also know that there is no taxes. So if you remember how to calculate weighted average cost of capital, we had such formula: weight of debt times cost of debt times 1 minus tax rate plus weight of equity times cost of equity. So why I calculate weighted average cost of capital? because it is also equals to the expected return on the stock. Okay, it right here, weighted average cost of capital is the minimum rate that investors expected from their investment. All right, so this is also shown as return on asset as a notation. So let's calculate it. Weight of debt is, as you see from here, it's 30%, 0.30. Cost of debt is 8%. There is no taxes here by the assumption, so this is 0, so this will be not affected. Weight of equity 70% and cost of equity is 16%. And from this, we calculate that we have 13.6% weighted average cost of capital or return on asset here. So in the second case, we have a new situation. In this situation, we are going to issue an additional $10 million of common stock, and by using this amount of fund, we are going to retire some exactly equal amount of debt, which means if we issue additional shares by an amount of 10 million, our debt will be lower to 20 million. So in that case, since this will be lower to 20 million here, weight of debt will be 20%. So ladies and gentlemen, and this amount will be 80 million. So let's, in this new situation, what is asked is what will be cost of equity in this new scenario. So let's rearrange this equation. We should write this 13.6% is the weighted average cost of capital. So weight of debt in this case is 20%, 0.20 times, well, this 8% will remain the same. Why? It is because of this assumption. The change in capital structure does not affect the risk of the debt. All right. In usual practice, it does affect, but in this problem, we assume that it doesn't affect. All right. So weight of equity in new scenario is 80%, and what is asked is cost of equity. If you solve this equation, you will find cost of equity is 15% here. Okay. So this is the solution. So let's move on. Well, here I also brought and explained solution in this form from your textbook. So we have this problem. This is a little bit tricky problem and a little bit longer than the others. So let's take a look. Reliable gearing currently is all equity financed. It has 10,000 shares of equity outstanding, selling at $100 a share. The firm is considering a capital restructuring. The low debt plan calls for a debt issue of $200,000 with the proceeds used to buy back stock. The high debt plan would exchange $400,000 of debt for equity. The debt will pay an interest rate of 10%. The firm pays no taxes. So A, what will be the debt to equity ratio after each contemplated restructuring? We have two restructuring plans. B, if earnings before interest and taxes, EBIT, will be either $90,000 or $130,000, what will be earnings per share for each financing mix for both possible values of earnings before interest and tax? If both scenarios are equally likely, what is expected or average earning per shares under each financing mix? Is the high debt mix preferable? So this is also for part B, we also have two situations. C, suppose that earning before interest and taxes is $100,000. What is earning per share under each financing mix? Why are they the same in this particular case? So let's start with the first one. What will be the debt to equity ratio after each contemplated restructuring? Now, first of all, let's calculate the market value of this company. What is the market value of this company? Remember, market value is equals to price of a share times number of shares outstanding. And this equals to $100 times 10,000 shares, which is equals to $1 million. Okay. So with the low debt plan, equity falls by $200,000. So debt to equity ratio will be equal to $200,000. Remember that at the initial stage we had no debt. So we have a plan. We have a plan to find a debt financing by an amount of $200,000. So that's why we have $200,000 debt. So equity, on the other hand, will be lower by an amount of $200,000. So it will reduce from $1 million to $800,000. And from this, you can see that this is 20.25. And in this case, if you pay attention, how many shares remain outstanding? Number of shares, remember here, the number of shares will be if you spend $200,000, divide by 100, this will be equals to 2,000 shares. And what is remained in the market is from 10,000 share, you buy back 2,000 share, so 8,000 share remain outstanding. Shares remain outstanding. So with the other plan, with the high plan, with the high debt plan, equity falls by $400,000. So debt to equity will be equal to $400,000 divided by $600,000. So result will be 0.67 debt to equity ratio. How many shares remain outstanding? Well, you will divide $400,000 by 100. This will be equal to 4,000 shares you bought back. And what is remained is 6,000 shares outstanding. Okay. Let's move on. Part B. In part B, Let's exercise the low debt plan. This is B. Low debt plan. Remember, we have, let me split this into two parts. We have low debt plan and high debt plan. Okay. So in case of low debt plan, now it is given that earning before interest and tax would either be $90,000 or $130,000. So we should deduct interest here. So what is interest? Pay attention, please. You have interest expense, cost of debt is 10%, and the amount of debt you require in the low debt plan is $200,000. So which means 10% of $200,000 will be equal to $20,000. So this will be $20,000 in both cases, because in low debt plan you get a loan by an amount of $200,000. So the result of this, there is no taxes, remember, and the result of this will be earnings here. You are going to have $70,000, and here you are going to have $110,000. So let's calculate earning per share. In both cases, you will divide this by amount of shares here. Remember, in this case, since you buy back 2,000 shares, the number of shares left was 8,000 shares here. Let me write here shares equals to 8,000. So if you divide 70 by 8,000, you will find $8.75 per share. Similarly, if you divide 110,000 by 8,000 shares, you will find $13.75. So you see, if EBIT increases, earning per share will increase in this scenario. In case of high debt plan, well, before moving on to high debt plan, let me complete this part. What is the expected earning per share? Well, remember, this is the case 1, and this is the case 2 and case 1. So remember, we have two situations, case 1 and case 2, and the likelihood of both cases is the same, which means white of this and white of this will be equal, which means the probability of each of these case occurrence is the same. So we can take the average of these two, $8.75 plus 13.75 divided by 2 will be equal to $11.25. So likelihood, this is also equals to, well, it comes from this if you don't understand, the P1 times probability of occurrence of first case times expected value at 1, and P2 times expected value of second case. So remember that probability is 1 over 2. So if you plug the figures here, you will calculate the same result if you didn't understand. Alright, so the result of this will be the same. So let's see what will happen in case of high debt plan. Okay, so let's calculate EBIT. Again, we have $90,000 and $130,000 situation. interest, let's calculate the interest expense here. Now remember, in the high debt plan, you take a loan with an amount of $400,000. So interest of this, which is 10% cost of debt you have, so that means you are going to pay $40,000 interest over this loan. So from this, you are going to have earnings 50,000, and here you are going to have $90,000. So let's calculate earning per shares here for both scenario. You will now remember, in this case you are going to have 6,000 shares. So if you divide 50,000 by 6,000 shares, you are going to have $8.33 per share, and for this one you are going to have $50 exactly. So expected earning per share here will be equal to average of these two, will be equal to 11.67. So remember the question, the last part of the question. If both scenarios are equally likely, what's the expected earning per share under each financing mix? We calculate this. The last part of the question, is the high debt mix preferable? Let's take a look. Now, in case of high debt plan, although you have slightly higher earning per shares, we cannot easily say that high debt plan is more preferable than low debt plan. Why? Because it is quite close. It's quite close. Why we cannot say this? It is because you have more debt in your capital structure, which means you stress your operations more by having such case. In other words, although the high debt plan results in higher expected earning per share, it is not necessarily preferable because it also entails greater risk. The higher risk shows up in the fact that earning per share for the high debt plan is lower than earning per share for the low debt plan when EBIT is low. Okay, here, please pay attention to here and here. But earning per share for the high debt plan is higher when earning before interest and tax is higher. So this is what we are trying to say. $15 is higher than $13.75. Okay, let's move on to part C. Suppose that earning before interest is $100,000. What is earning per share under each financing mix? Why are they the same in this particular case? Okay, let's calculate. We will do this again under 100,000. So this is C. So earning before interest and tax is $100,000. This is the case with low debt plan, and let me write here with high debt plan. So again, let's write here earning for interest and tax will be $100,000. So less interest in this case, if you remember, interest in this case was over $200,000. You are going to pay $20,000 interest, and here, if you remember, you are going to pay $40,000 interest. So from here, you are going to have earnings, $80,000 earnings, and here you are going to have earnings $60,000. So let's calculate earnings per share. In this case, you had 8,000 shares, and that's why earnings per share is $10 per share. Now in this case, earnings per share will be, remember you had 6,000 shares, so earnings per share will be again $10. So why these two is the same? Well, earnings per share in both cases is the same for both plans because earning before interest and tax is 10% of assets. Remember what was the assets value, which is $1 million, which is equal, well, which is equal to remember the rate, be careful, the rate the firm pays on its debt. All right, so if you have such situation, then there is indifference case here. So let me move on. You can also check this. Let me give you 2 or 5 seconds to see the answers here. And here we have another problem. By this problem, again we have a situation of leverage and capital cost. So let's take a look. Hubbard's Pet Foods is financed 80% by common stock and 20% by bonds. The expected return on the common stock is 12% and the rate of interest on the bond is 6%. Assume that bonds are default free and that there are no taxes. Now assume that Hubbard's issue more debt and uses the proceeds to retire equity. The new financing mix is 60% equity and 40% debt. If debt is still default free, what happens to the expected rate of return on equity? What happens to expected return on the package of common stock and bonds? Well, you should calculate weighted average cost of capital here. So again, weight of debt times cost of debt times 1 minus tax rate plus cost of equity times weight of equity. So plug the figures here. So 80% of common stock here. This is 80% weight of equity. So weight of debt will be 20%. Cost of debt will be 6%. Tax rate is 0, so this will be 0. And cost of equity is 12%. And result of this will be equal to 10.8%. So in the second situation, what they say, they change the financing mix and ask you the expected rate of on equity, which means in the new case, since you have 10.8% weighted average cost of capital, now in the new situation, you need to calculate cost of equity because cost of debt remain the same, what they say. So cost of debt was 6% times weight of debt in new situation is 40%, 0.40. There is no taxes, so this part is 1. Cost of equity, this is what is asked in the new situation. Weight of equity as it is given is 60%, 0.60. From this equation, you can solve cost of equity and find 18%. All right. So the next question, you can also take a look here. Again, we have another problem here. Leverage and capital cost, similar problem, almost similar. A firm currently has a debt equity ratio of 1.2. The debt, which is virtually riskless, pays an interest rate of 6%. The expected rate of return on the equity is 12%. What would happen to the expected rate of return on equity if the firm reduced its debt equity ratio to 1/3? Assume the firm pays no taxes. So here, again, you need to calculate weighted average cost of capital. Well, remember, weight of debt times cost of debt times 1 minus tax rate plus cost of equity times weight of equity. So what is weight of debt in this situation? If you have debt to equity, if debt to equity, that means debt to equity, this debt to equity is equals to 1/2. So in this situation, that means weight of debt is equals to 1/3 and weight of equity is equals to 2/3. Well, to prove this, just plug 100 here and 200 here. So in this case, 100 divided by 200 will be equal to 1/2. So weight of debt means debt divided by debt plus equity, which means 100, for example, divided by 100 plus 200, which is 300. You see, this 1/3. Okay, so weight of debt is 1/3. What is cost of debt? 6% plus cost of equity is 12% times weight of equity is 2/3. So the result of this will be 10%. So in the new situation, it says debt to equity ratio is 1/3 instead of 1 to 2. So you need to now calculate this, and the new financing mix, what will be cost of equity? This is what is asked. So again, 10%. Let me erase this one. 10% is weighted average cost of capital. Well, what is weight of debt in this situation? Let me show you here. Well, if debt to equity is equals to 1/3, then I can easily say that weight of debt is 1 to 4, which is 25%, and weight of equity is 3 to 4. From this logic, you can prove by yourself here. So 10% is equals to weight of debt is 10%. Weight of debt is 1 to 4 times cost of debt will remain the same as we understood from the problem, 6% plus cost of debt times 3 to 4. And from here, cost of equity, you can calculate cost of equity from this statement, this equation as 11.33%. All right, and this is done. And you can also check this solution as well. So Thanks for watching this tutorial.